Okay, we're going to start today by looking at the front page of Yahoo Finance. You can see the most important stories of this week are the war in Iran. That's affecting the price of oil, which is a major cost for every company in the world. And we have NVIDIA having its once a year conference, and um, that really juices a lot of the AI stocks that are involved with that company. And what else is happening here? We have a lot of uncertainty involving the Strait of Hormuz. So uncertainty is one of the biggest um, problems in the stock market. When there's uncertainty, the stocks usually lose their luster and go down. So right now, here it is again. Oil climbs 2% as Iran war halts supply. So this is a really big deal. If the Strait of Hormuz remains closed and oil doesn't go through, then that will make inflation go up because the price of oil goes up. Um, Oil is one of the biggest input costs for inflation, and also that slows economies down around the world as the price of oil goes up. Um, com Countries are not as productive, and in general, the economy slows around the world. So that is what's that's what's causing a lot of the stock market gyrations now. Okay, so let's look at the S&P 500 chart. You can see we had an uptrend since last April, and that uptrend stopped about 2 weeks ago. We could right here, and we're starting this downtrend. So what that tells us is anyone in the stock market that's been playing a momentum trade where we have higher highs, higher lows, and going up. This is like um, the first sign that we're not going up like that anymore, and we could start a consolidation downward. So you can see that we're oversold. This is 11 in the stochastics, which is pretty low. This is about as low as you can get. Also, in the S&P oscillator, the S&P oscillator is negative 7.8, which is really low. That whenever it's negative 7.8, that's a sign that the market is exhausting itself, selling. Okay, so let's look at some of our talking points. Okay, this week we're having two important AI events. One is GTC, NVIDIA's yearly announcement of things that they're doing. That's all week long. Um, we have Micron coming out with their earnings on Wednesday. It's interesting that the new chips that are made by NVIDIA require almost double the memory as prior chips. So Micron's biggest customer, which is NVIDIA, is almost doubling their need for memory, which will raise prices. So that's really good for Micron. And what else is happening here? We have triple witching this Thursday, uh, this week. So we basically have a day when options expire in a major way, and there's going to be a lot of volatility. So expect a lot of volatility this coming Friday. And that triple witching happens 4 times a year. Simultaneous expiration of options and a lot of derivatives. So let's look at some more talking points. Yeah, this week we had earnings come out from Oracle, Adobe, and Hewlett Packard. This coming week we have Micron is the only basically major tech stock reporting this week. And let me see. So a lot of times whenever earnings come out, if the stock goes up towards the earnings print, then you might have a sell on the news. So if you buy in the rumor, sell on the news. So we don't know which is going to happen, but people are buying Micron on Monday. So maybe it might be sell on the news. I don't know. Um, we'll go over Micron a little bit later. All right. So we're having a loss of momentum in the stock market. Only 32% of the stocks are above the 50-day moving average and only 49% above the 200-day. And so what happens is if you get less than 30%, that's a bearish market. In other words, stocks will be trending downwards instead of trending upwards. So we're making a switch right now to a downward trending market from an upward trending market. And we're kind of rotating to more conservative stocks that are doing the best now. Okay, you can see seasonality wise, March is a good month, but right now we're in a crisis. So you could throw out everything about stochastics and seasonality out the window whenever there is a crisis, such as a war or the biggest disturbance of oil in the history of mankind. So let's keep this in the back of our mind, but it doesn't really work whenever there's a crisis. All right, so let's look at, okay, we already mentioned we have a negative 7.87 on the S&P short range oscillator. That is an oversold condition. Whenever the value is below 5 or approaching negative 10, it indicates the market is heavily oversold, suggesting a potential rebound. Okay, so when you're investing, you have to do basically the opposite of what the market is doing, and a lot of times. And whenever the stock market um, is oversold, that's when you start looking for things to buy. And when things are overbought, then that's whenever you don't buy or look for things to sell. All right. So, and we're losing a lot of our um, momentum in the stock market and our support. But we do have this 200-day moving average, which is holding up right now. If we break through this 200-day moving average, which is the purple line at the bottom, then look out below because we have no support anymore. Whenever we are in this downtrend and we break all of the moving averages, most likely we're going to bounce on this 200-day moving average. But if we don't and we start going below that, we have these prior levels of support. So right here where it bounced, right here, 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 and it kind of goes back like that. And those are the next levels where there's support in the stock market. And of course, the ultimate support level is the last April when we crashed. And right there, that is a level that would probably hold if we ever get down to there. But the reason why we're going over this S&P 500 every week is 90% of stocks follow the S&P 500. So we want to be, and 100% of money managers follow these moving averages, and the algorithms also follow the moving averages, and they're ready to buy whenever a stock or index bounces on the 200-day moving average. Okay, and this moving average, if enough people believe in something, it's going to be true. And there's enough coverage of this kind of activity on the TV and the internet that it becomes something that works. All right, so let's look at what else is happening here. Um, Okay, the United States Treasury yield has been going up. You can see that there's a noticeable uptrend since the beginning of March. And that affects a lot of industries. The biggest industry is the housing industry. That's very negative for the housing industry because it makes housing more costly for home buyers. So that reduces the demand. But look, we do have this correlation where as interest rates on a 10-year go up, the stock market goes down. So there's an inverse correlation. And that's because in general, the higher interest rates are, the less profitable companies are because they have to spend more to borrow money to grow. All right. And let's look at some of our major variables in the stock market. The price of oil is up 15%. We have the Iraq closing the Strait of Hormuz is a major issue. Supply goes down and the price goes up because of that. And high oil is inflationary. So that's going to make all products more expensive because oil is the main cost for a lot of companies, whether it's delivering a product or if you're making plastic, you use oil to make plastic, etc. So inflation is still at 2.4%. The US dollar index is going up. So let's look at the chart of the US dollar index. You can see that lately it's been going up in a major way since the beginning of March. But we are in a sideways pattern. So that has like a no effect on the stocks that we're following because if we're just doing a sideways move over a year, that that currency doesn't have a whole lot of effect on companies in that instance. All right, let's look at gold. It's down 2%. Um, and all right, that's all we can get from this. Fear and greed index. We are at extreme fear. Okay, so extreme fear, translation, time to hold your nose and buy and don't sell. Right now, we're this S&P oscillator index is negative 7.8. Jim Cramer says whenever it gets to that level, you have to hold your nose and start buying things. So, but the last thing you want to do is to sell out of all your positions because it's whenever there's extreme fear, you want to do the opposite of what you're feeling because whenever there's deals, you don't want to be selling, you want to be buying some. All right, so let's look at the AAII sentiment survey, and we have bearish. So the opposite of, we have to do the opposite of what the amateur investors are doing. So it's time to start looking for something to buy or don't sell. All right, and the VIX is now at 24. So we are right at the edge of fear gripping the market. When it gets up to 30, then we have something similar to panic. And when it's at 50, then we have a super capitulation, and it's almost a certainty that there's going to be some good stocks to buy at that time. And let's look at, so we're right in the middle of fear and capitulation right now. If we have some more problems with the Strait of Hormuz, where oil doesn't go through, and then we have a supply issue with oil, we could very easily get to capitulation and despair. Let's let's look at the worst of first. Okay, so the best performing sectors last year: communication services, IT, industrials, S&P 500, and financials. And this year, it is totally flipped, and the worst from last year are the best this year. We have energy. Energy was only up 4% last year. It's up 29% this year. And we have very conservative sectors such as real estate, consumer staples, materials, utilities, all up this year when the ones that did the best last year are down. So that's a good lesson learned that you have to be diversified in your portfolio and start. Then you want to try to have an even amount of each of these sectors in your portfolio so that you can handle market gyrations. And usually, whenever in a good portfolio, you don't want everything going up at once. You want some stocks that are doing good and some stocks that are not doing good because um, on average, that yields a better portfolio over time. Okay, so let's look at some of um, the sector PE valuations relative to history. Financials right now, they're taking a hit because of this subprime, because of there's a crisis right now with private lending. And even stocks that have nothing to do with private lending um, are being taken down with, it's like throwing the baby out with the bathwater. So right now, it's probably a good time to start looking to dollar cost into some financials if you don't have it in your portfolio right now. And usually, um, whenever there's a crisis right now, like right now with this private credit, um, you have to like figure out if the private credit has anything to do with the companies that are going down. And if so, you put a little bit in time because it's called catching a falling knife. You don't want to catch a falling knife. You want to buy a little bit at a time if you're interested in buying a stock because it might go down more. Healthcare is an out of favor sector right now. Real estate, utilities, materials. So these are all undervalued relative to history. But the ones most expensive compared to history, industrials, IT, and consumer staples. Okay. So so right now the safer sectors to buy, if you're interested in buying right now, are these sectors here, which is healthcare, financials, real estate. All right, so let's look at some of the stocks going up and down in the stock market. Let's look at what pattern we have here. Okay. Okay, so we have some AI stocks in the top gainers. We have SanDisk, we have Western Digital. These are suppliers to the data center. SanDisk makes memory, Western Digital makes hard drives and flash memory, and Seagate, another provider of hard drives and flash memory for AI data centers. Um, we have Dollar Tree, they just reported earnings, and Mondelez International, they make snacks and cookies and things. So that's a very conservative company that pays a dividend. And okay, so these are kind of half of them are conservative, half of them are AI related. United Airlines. The airlines are going up and down based on the price of oil. Oil is the biggest cost of airlines. So as the price of oil goes up, the profitability of airlines goes down. All right, so we have the ones going down the most. CF Industries. This is a fertilizer company that was going up a lot recently. Um, we have CrowdStrike. CrowdStrike is the number one provider of cybersecurity in the world. So whenever a stock like CrowdStrike goes down, I like to look at it to see if it has any credence because when you have a number one in an industry going down, maybe it's a good bargain. But right now, CrowdStrike is very overvalued, but we'll look at it anyways. Um, okay, Domino's Pizza. I don't know why these companies would go down. All right. That's all I can get from that. Let's look at we know from, we know from our, hold on. Okay, we know from our 10-year treasury, the yield is going up. So our translation is, okay, when a yield goes up, then companies that need to borrow money go down, and companies that pay a dividend go down because there's a less of a demand. Let's see if that's working out this time. Okay, the ones going up the most right now are semiconductors, gold miners, and metals, home construction. Okay, that's interesting. We would, if the price of the 10-year goes up, the yield goes up, we expected home to go down because that makes home builders less profitable. Biotech is going up. As the yield of the 10-year goes up, companies that need to borrow money should go down. So I wonder why. Because State Street Oil and energy are the ones doing the worst. And that's these sectors just go up and down based on the price of oil. All right, that was a good exercise. Okay, so where were we here? Okay, so let's look at Dan Now's picks from this year. Some of these are really bad. The PI Impinj is down 43%. Apple is down -7%. Boeing is down -4%. Nike is down 14%. So the only one that's in positive for this year is Cisco. So this year, Dan didn't do so good. We're going to keep watching those though. Um, okay, so every day in the stock market, we basically have what's known as a risk on trade or a risk off trade. So it's good to review this every now and then because you have to understand why these sectors um, go up or down together. So in this instance, we had a risk on trade in this day we're looking at here because risk on is very risky investments going up. So risk on is communication sector, IT, financials, industrials, consumer discretionary. A risk off is whenever gold, silver, materials, energy, consumer staples, utilities, and healthcare go up. So right now we had a risk on day, whereas some of the more conservative sectors, such as utilities, consumer staples, energy, are going down. So it's important to have a little of both of these in your portfolio so that whenever you do have risk on days, you don't miss out. And whenever you have risk off days, you're protected by when these stocks go up. So right now, the war with Iraq is causing a lot of uncertainty, and stocks that have low volatility, low PE ratios, low PEG ratios, and paid dividends, they are going to be more stable if we continue to have problems with oil in the world. I thought it'd be interesting to look at some stocks that came up on my watch list. Um, we talked about waste management last week. You can see we're like in an uptrend here. Um, the theme for waste management, they have a duopoly in waste disposal. You can see that they're in an uptrend here. They're very near the bottom end of their channel, and they're oversold. And they came out with earnings and they went down like 5% last week. And you can see that they're holding their 20-day exponential moving average, which is the yellow line right here. And it's a domestic company. It has nothing to do with um, the war in Iraq, other than they have a price of oil as a major input cost of their business. Okay, let's look at another stock. XAR. This is the defense ETF, the State Street Aerospace and Defense ETF. You can see that we had a run up after the war started, but you can see we're down to the bottom end of this trend line and we're oversold. Just think of how much um, these defense companies are going to make if we keep dropping bombs all around the world. So that's sector to watch. Okay, I did a stock screen. I thought it'd be interesting to highlight some stocks. Um, I like to mark stocks in green. Let's look at the stocks on the actual spreadsheet. Okay, so I like to highlight the top perfor performing stock with the green and in the different categories, such as market cap, cash flow rate, return on equity. Um, return on equity is an example. Like Mastercard has one of the highest return on equities, but their PEG ratio is one of the worst, which is 2. So I try to look for green across the line for a good stock idea. Like for instance, right here we possibly have um, a stock with a 1.22 PEG ratio, 39 return on equity, cash flow rate 5 years is 40, not 50. So I like to look, that's how I do my screens. This one right here looks great, but it's kind of an unreliable stock. Um, so I thought it'd be interesting to go over some of the stocks I found in this screen. One of the stocks that always pops up every week is Micron. They're having their earnings come out this Wednesday. So I thought it'd be interesting to go back and look at Micron again and, and talk about some of the interesting things that are happening at NVIDIA at their meeting. So the interesting thing about NVIDIA's next generation AI chips, the Rubin architecture, they're driving an unprecedented surge in memory demand, with each new chip requiring significantly higher memory capacity. So we know NVIDIA is Micron's number one customer. And as they roll out the new Rubin chip, there's going to be almost a double demand in memory because of the new chips require more memory. So there's going to be almost double demand from their biggest customer, and that's a really good sign that they can raise the prices, and the company will do good. So I thought it'd be interesting. Um, according to Fidelity, the PEG ratio is 0.38. So I thought it'd be interesting to look at that one again. They said the forward EPS long-term growth is 105. Their return on equity is 22. So look, we have a lot of green here. The PE next year's estimate is 7.5, which is 1/3 of the stock market. So I thought it'd be, and other things I look at on my screens, you can see a lot of banks right now. Whenever we looked at let me see, right here. Whenever we look at some of the valuations that are the lowest in the stock market, the financials right now are the least in favor, and the valuations relative to history are very low. So, but right now we're in a crisis in that, and you can see that there's a lot of banks in our screen here. Blackstone, there are companies like Blackstone that are more affected by the um, private lending crisis because they have a larger portion of their portfolio involved with that. But companies like Goldman Sachs have almost maybe a 1% exposure to that, which isn't that great, which isn't a lot, but they're being thrown out with the bathwater. The important thing to keep in mind with these stocks in general, when there's a crisis, the really good stocks like Microsoft, Facebook, Google, they usually go down to their peg ratio of 1. And you can see some of the good stocks here, like Goldman Sachs, it's a peg ratio of 1. Wells Fargo, it's a little bit less than 1. Citigroup has a half, according to this, it's half off. So you can see that we are in a situation where a lot of financials are being sold off. I'm not an expert in financials. It's a different. I kind of study growth stocks, and financials are a bit different animal, and I haven't really figured those out yet. Um, so I won't be going over any of the financials this week, but we're going to just mark them as an undervalued sector. And a lot of times, if you want to have a diversified portfolio, you have to have a little bit of every sector. And right now, this sector is starting to be on sale. Okay, so let's look at. Okay, we saw waste management. We see. Okay, I thought it'd be interesting with Micron coming out with their earnings this Wednesday to look at Micron again. You can see that from this year to the next year, Micron's projected to grow their earnings 12%. So right now their PE ratio is 14. So that makes Micron about fair value, for the current growth rate from year over year to next year. But look at this from 27 to 28, 192% growth. So if you try to figure out the PEG ratio, 192 divided by the PE ratio, that gives you that they're 13 times undervalued if this number is correct. So this jump from $17 a year in earnings to $51, that is pretty big. And even Yahoo Finance says they're about half priced right now. So their numbers look really good. Profit margin is 28, operating margin, their return on equity is 22. That's just what we're looking for. And they have around 2 billion in debt, which is not a lot for a big company. 2 billion out of 497 is pocket change. And they make half a billion in free cash flow every year. So this company's still screening pretty good. But you can see from their stock that they are going up towards the print. So a lot of times they're buying on the rumor now, and it's overbought. So whenever earnings come out, don't be surprised if you have sell on the news, which it'll go down maybe to this bottom part of their trend line. Okay. Okay. I thought it'd be interesting to go over another stock, which is number one. We saw CrowdStrike as a stock that's going down a lot. Here is right here, top decliners for today. So I thought it'd be interesting to go over CrowdStrike. They're a cybersecurity company, number one in the world. And a lot of these software companies are going down together. And because there's a fear that AI is going to displace a lot of the companies in the software world. Um, so let's look at their growth rates. 31%. So they're growing around 30%. Their PE ratio, forward PE is 90. So that's 3 times overvalued. So people are paying, and that matches Yahoo Finance's 3.5 PEG ratio. So this stock could drop 1/3 and it would be fairly valued. So it's a very volatile stock and it's not undervalued. I try to stay away from stocks with high valuations with high PEG ratios like this because um, I like to keep with stocks that are lower PEG ratios. And the profit margin, that's -3 That is not good at all. And the return on equity is -4. So all in all, this stock doesn't pass any of the screens. It's overvalued and they're not very profitable. So I'm going to stay away from this one. But you can see the stock has gone down with the software stocks in the software AI SaaScopolis, whatever they call it. It had a little bounce right here, but now they're overbought. This is kind of a dangerous time to start looking at this one. I guess if this stock went down a third of where it's at now, so if it was $120 a share, I would start looking at it. Um, okay, here's another reminder we had last week. Um, we had a lot of crises in America. We had Black Monday, we had tech bubble, temper tantrum. Everything sounded really bad at the time, but the stock market kept going up. So the important thing to keep in mind is even though we have this big problem with the Hormuz Strait, it's going to be resolved eventually. And it's going to be, we're going to look back at one of these is going to be Strait of Hormuz, Iraq War, and the market powered out of that and kept going up. So right now we have a crisis. A lot of stocks are directly correlated to that, but just think of the stocks that we're following, such as Google. How does the price of oil affect Google's bottom line? Or Facebook or a lot of the other companies we're watching. So just keep that in mind. And hmm, okay, so I think that's all I had to say for today. I hope you enjoyed the talk. Hope you have a good investing week, and I'll see you next time.